Okay. All right. So now that I'm not talking to myself,
Hey, did you, where is the file located?
it should be in your email. It's also in Blackboard.
Which one is it in Blackboard?
It's in under the course documents. Is there anyone else that didn't get the email? I said it incorrectly. Is there anyone that got the email?
I got the email today.
I'm sure I have the email. I can't open my email on my computer.
Oh, okay. All right.
I'd rather not do it on my phone.
Right. Yeah, so it's down there a ways. It's I should number these or something. Yeah, it's down about I don't know, 6 from the bottom.
It's the, which one is it? The chapter 10?
Chapter 10 handout. Yeah.
Chapter 10. Okay,
Yeah.
thank you.
It's the same one we did last week. What we started last week. Okay. Yeah, so the bonding employees. So, and by the way, just to avoid confusion, I do resend the files back out, even though we've already done it, because sometimes people are, on a different computer or whatever, and so they can just easier to get the files that way. So I do resend files that are, even though, for instance, this chapter 10 I sent out, even though I sent it out last week, it's because if someone was on a different computer or something. Okay. All right, bonding employees. So bonding of employees is simply an insurance policy. Now, the beauty of it is that they'll do background checks on people before they bond them. The insurance company, the bonding companies will. So bonding employees, it's just an insurance policy. It's for people that handle cash or have access to cash. So cashiers, people in the Treasury Department, those people that have access to cash. It's an insurance policy specifically for theft of cash. If somebody steals merchandise, nothing to do with it. But it's only for people that are stealing cash. Now, the important thing is they do background checks. So, it's not just that they're bonded and you get this insurance policy, but the big thing is they do background checks because the insurance company wants to limit their liability, and they'll do background checks. And I did have a friend who worked at a place where they hired somebody, and he worked in the Treasury Department, and the Treasury company wouldn't bond the guy. And they found out that the guy had actually done crime. Yeah, actually did time in a federal prison. Of course, that didn't come out in the interview, but he did time in federal prison for fraud. So, in the insurance company, their point of view is you can hire him, but we're not going to bond him. But, it actually is a background check on it. Okay, so bonding of employees, it doesn't necessarily in and of itself increase the internal controls of a company, but it does at least have somebody else take a look and see if they are hiring somebody who has the integrity to handle cash, basically. Lockbox Service. Instead of the client receiving customer payments,
Okay, Mr. Taylor, would you mind giving me going over number 1 and number 2 again?
Okay. I can give you this after class too. We can go over it. Number 1 is C and D. Number 2 is that was from last class. So.
Oh, thanks. I don't know where my handout went. I don't know if I was able to start it or not.
Okay. Well, after class, I can put it out. We can go through the first one. That's not a problem.
And
Okay,
the answer to number 2 is A?
A, yep.
Okay, thank you.
Okay, instead of the client receiving the customer deposit payments and making a bank deposit, customer checks are sent directly to the bank. Okay, so a lockbox service. A lockbox service is a service that the bank provides. And instead of going through the whole process like we did up here, instead of all this, it goes directly to the bank. So and this is very common, actually, when you pay off, if you're paying on a loan or whatever, or credit cards, all the time, a lot of times that payment goes into a lockbox. It'll be a bank address. It goes to the bank, a certain PO box. All those letters for that are opened, they're deposited by the bank directly into your account. The checks are sent for collection in the banking system. So the checks never actually go to the client. They never go to the company that is receiving it. They never see it. It has a few advantages, as you can imagine. One of them being that you don't have to worry about all these controls over the cash, the two people in the accounting room. You don't have to worry about the checklist going to the accounts receivable. The checklist will go to the accounts receivable from the bank, and that's it. No one actually handles the checks themselves. They all go directly to the bank. The return address for the payment will go directly to the bank. So the lockbox systems are very popular. If you're making payments and stuff, most of the time it's going to be to a lockbox system. Okay. Which following are true regarding a lockbox system for cash receipts?
E.
E. Yeah, the employees will never have access to the cash. So all the rest of these, the clients always will have access to customer checks. Nope. They'll need additional bonding. They won't need bonding. There's no cash. They won't be handling cash, or the people in the mailroom or whoever opening up won't need to be bonded because they're not opening them. It'll be a longer delay. It'll be shorter. You don't have to make the deposit slips and all that, and have someone run over to the bank. And the clients, employees will never have access to the customer's cash. Okay, so those are all no good, except for this last one. That is a good thing, and that employees won't have access to the customer's checks. It's one less thing to worry about. Okay, disbursements of cash. So cash is obviously a very desirable asset to get. So anyway, people can get money out of the place, you have to be careful of. And one of those things is getting the company to actually pay out cash for goods, right? When you buy goods or services, you got to pay for those things. And so the question is, well, what controls are there to make sure that whatever you're doing, whatever you're paying for actually existed or was received or the work was done and all that kind of stuff. And there's actually 3 documents that we need to match up before we're going to make a payment. Now, here it's talked about vouchers payable. This is also true for accounts payable. Vouchers payable and accounts payable are basically the same thing. Vouchers payable will add one more document called a vouchers payable. It'll go from an accounts payable to a vouchers payable. It's just one more document, and the voucher payable just says that everything has been approved. The documents have all been lined up, but either way, all 3 of these documents have to be lined up before it'll be paid. So while this is vouchers payable documents, this could also be okay. The first document that starts things off is purchase order. Okay, so the first one is a purchase order made by the purchasing department. So if you need something in the company, you say, okay, I need, whatever it is, you need a desk, or if you need inventory or whatever it is, you say, okay, I need, let's say a desk. I need to get a new desk for an employee coming in, we need to get another desk. You got to go through the purchasing department. The purchasing department will have vendors that are all lined up and approved. They'll have things that you can buy, things that you can't buy. So if you put in that you want to buy a Ferrari, they'll probably say no. But they'll have approved items that can be ordered as long as they have approval from management. And once those approvals are made, then the purchasing department will put in a purchase order sending it out to whoever it is, saying, okay, look, we need to get a desk. And that purchase order for the desk will go out to one of the vendors, whatever vendor sells the office equipment or desks or whatever they are. Okay. The second document is a receiving report made by the receiving department. So a receiving report made by the receiving department. All right. So they put in the order. And when the order arrives at the business, it'll go into the receiving department. The receiving department, they generally have a purchase order that doesn't have any quantities on it. The reason for no quantities is they want people to count it. So either electronically, it won't have quantities, or if it's on a piece of paper, it'll have the quantities blanked out, because you want people to count what comes in to make sure that what they're sending you is exactly what you ordered. So if you ordered 12 items, check to make sure they sent 12. Or they only send 10. So whoever's going through it will count them. So anyway, this desk would arrive at the receiving department. There'd be a receiving report made for this desk. Okay, and to go along with the purchase order. All right. And let's see here. And the last one is the vendor invoice. Sent by the vendor. And the vendor invoice. So the vendor sends the invoice saying, okay, this is what you owe me. I sent the desk. Now this is the bill for it. You're going to check that to make sure that the price matches up to the purchase order. You're also going to check to make sure that the quantity that was received is the same quantity that is on the receiving report. So if the receiving department only got 10 and they ordered 12, make sure that the invoice is only for 10 because that's all they sent. They didn't send 12. So you're going to make sure that the receiving report matches the invoice and that the price matches the purchase order. If there's a discrepancy, then it doesn't get paid until it gets figured out. So purchase order, you actually ordered it. Receiving report, you actually received it. And then the invoice, and that's just to make sure that the quantity that you received and the price are exactly the same as the purchase order and what is on that receiving report. Question on that thing? And by the way, if one of those is missing, what do you do? Well, you don't pay it. I mean, and that is the control. The control is that all three of those have to be there. Companies will sometimes, or bad businesses will sometimes send something to a company. They'll receive it even though there was no purchase order, then send them a bill for it. And if they have sloppy enough control, sometimes they pay it. So you have to be careful about stuff like that. We put in a purchase order, they don't send anything, but they send a bill. So that's why you need the receiving report. And you need to have the invoice. They have something to actually pay. That is the agreement with the vendor. So you need all three of those need to be matched up before you make payment. So those are the documents we have for cash disbursements. Purchase order, receiving report, and vendor's invoice. Okay. Lapping. Lapping can occur if the accounts receivable clerk has access to customer checks. It's a little smaller. accounts receivable clerk. Misappropriates, my favorite word. Steals a check. And covers, oops, the theft with future. Okay. That being can occur if accounts receivable clerk has access to customer checks. The accounts receivable clerk misappropriates, steals a check, and covers a theft with a future check from other customers. And I'll show you what I mean by that. See, some teachers just talk about fraud. I show you guys how to do it. You know, this is how you do fraud, okay? Well-rounded education. Okay, so so the check is made out to the payee, and you'll notice that it's made out to Bedrock Corporation. Okay, so Fred sent a check for $4,000 applied to the account. We'll put the whole $4,000 to the account. Okay. Now down here, the accounts receivable clerk is a compulsive gambler and steals a $5,000 check from Wilma and cashes it at the racetrack. The clerk covers it with the other customer's payments. Okay, so this cash check here. So they take the $5,000, whatever the clerk is, takes the $5,000 check. Okay, now there's a problem though. Because, I forget who this is, Wilma. Wilma will be expecting her account to show the $5,000, right, that had been paid. So if the clerk doesn't do something, this is going to get caught pretty quick. So the clerk says, okay, I know what I'll do. The next payment that comes in, I'll take some of that money and pay off Wilma's account. That gets Wilma off my back. Okay, so. Not that. So applied to the account 0. But now there's owed 5,000. Oops. Okay, so we take Barney's check and say, okay, Barney, here we're going to take his check and say, okay, we're going to take 5,000 and pay off Wilma. What did it say? Owed. Yeah, I'll leave it like that. Okay, now, how much gets applied to Barney's account?
3,000.
Yep. So of the $8,000 check, 3,000 gets applied to Barney, and now Barney is owed how much? 5,000, right? We'll see it, John, if I can bold this or not. Yeah, I can. Okay, so. We split up the $8,000. We paid off Wilma. Wilma's off our back. Now we got Barney on our back. We still owe Barney $5,000. Okay, well, Betty comes in. And Betty pays off the $5,000. Now we got Barney off our back. And Betty gets the other, what, 1,000? Added to her account. So now we got Betty on our back, but you'll notice that Betty is near the end of the month. So it would be less likely for Betty to get upset because she paid the payment on the 30th. And she might, so she might call in and say, wait a minute, why only $1,000 get credit my account? And who are they going to send her to? Probably the accounts receivable clerk. Accounts receivable clerk looks at it. No, it's fine. Your money's there. I can see it. They've probably already covered it with another payment. So this is a couple of lappings when now if the accounts receivable clerk takes the money, goes to the racetrack and wins and pays the money back, you might never know about it. But of course, a lot of times things like this, and gamblers, it kind of doesn't work out that way usually. So anyway, a lot of times now notice this is an employee who's never going to take a sick day. They're not going to take their vacation either. Because if they do, someone's going to come in and say, well, what is this? Why are there all these accounts that don't have, that we have checks for that are still all these big balances or whatever. So a lot of times people who commit fraud, they are the best employees. They're the first ones there at the office. They're the last ones to leave, and they don't take sick days because they can't. So this is a lapping example. Okay. Ways to detect lapping. I wish the following are ways. Okay, the first one.
C.
C is correct. There's one more.
A.
So actually, those two are both good ones. So the daily checklist, you should be able to look at the total checklist, whatever was whatever that checklist total was, and that should match what is put into the accounts receivable. Notice that had they done that, this would have been caught because the amount deposited should have been all these together, whatever that is. I don't know. 14 and 9 is what, 23,000? And that there was only what, 7 or 15,000 deposited. That didn't come out right. I don't know. I did my math wrong here somewhere. There's 5,000 missing. There would have been $5,000 short at some point. So if you take the daily deposits checks and then compare that to what gets credited to the customer accounts, that should tell you they should be the same. Also, they should be made intact. So Barney's $8,000 check, there should be a $8,000 amount. It should go in whole, right, to Barney's account. So if Barney pays $8,000, there should be an $8,000. Notice there wouldn't be. There'd be a $5,000 and a $3,000. So it's not intact. It's not going in you know, as the whole amount. That's also an indication that there's lapping going on. Quite honestly, though, the real solution to this is that segregation of duties. Did I put that in here? Yeah, here. Custody of the assets, the check, and record keeping is the accounts receivable. If the true thing is, don't give the accounts receivable clerk the checks. That's the best solution to it. Then it can't happen. Okay. All right. Electronic funds transfer. This is kind of remedial on you guys. This is electronic funds transfer. They're transferred electronically without a check. This is very common nowadays. And there's some places that they won't do it any other way. If you get a mortgage nowadays, almost all the time a lot of time anyway, they say that you have to, it has to be electronically made. And this takes, again, kind of like the lockbox thing, but even one further in that it doesn't even there isn't even a check written, that it's taken, is transferred immediately. Employees have no access to it. And quite honestly, even the bank employees have very little access to it unless they have it in their computers, but physically they don't have any access to them. Many companies will not do business unless it's electronically. Okay, standard bank confirmation form. And I thought I included one of those in here. Okay. The bank confirmation form is not a bank statement. A bank statement shows all your activity. A bank confirmation form, a standard bank confirmation form, shows the accounts you have, the balances. It'll show the loans and all the details with the loans that you have with the bank. It basically shows all the business that the client has with it. That's a standard bank confirmation form. So it's different than a bank statement. It doesn't have any transactions on it. It just has the ending balances in the accounts, ending balances on any loans, and the terms of the loans. So let me write that in. Two keys in there. Yeah, they'll tell me. Okay, so standard bank confirmation form. So you do an audit, you get this standard bank confirmation form, and the confirmation form, again, is just it's kind of like a snapshot of this is what all the agreements that we have, this is what is in the accounts, this is what is owed at a certain point in time. But it also has detail about those agreements. So it'll say what the interest rate is, it'll say what the collateral has been pledged and all that kind of stuff. How long it's gonna take them to pay off, and all the rules of it, basically. So these are all be in that standard bank confirmation form. Okay. Year-end bank statement. Used for making the bank reconciliation. This all deposits. Too many L's. Yep. So it lists all deposits and disbursements for the month.
Shouldn't it be for the year because it's year ending?
They usually do it by the month. It could be for the year. Now the year-end bank statement will usually be on for 12/31. If they didn't send you any bank statements for the entire year, yeah, it would be for an entire year, but usually they go by the month. So this would be for the December, usually of December. Although I'll tell you a crazy one that came up in an audit that I had. So it usually it would be reconciled to the month of December. Now, notice this has transactions on it, whereas this doesn't. The standard bank confirmation doesn't have any transactions on it. This actually will have the transactions that you need to make your bank reconciliation. I had a really weird audit one time, and it came about because management was, I don't know what they were thinking, but management put out a rule that all bank accounts must be reconciled on the first of the month. So on the first day of the new month, it must be reconciled. Now, you didn't even get the bank statements back then until 2 or 3 days into it. But there were, in this one area, there's one manager was a real stickler about it and said, no, these have to be reconciled on the first day of the month. They didn't have the bank statement to reconcile it to. So they would reconcile it to the previous month. So they would have thousands of outstanding checks, thousands of deposits in transit and all that kind of stuff. It was the craziest thing I ever saw. This thing was, it should have been probably like, I don't know, a page long or something. It was literally like 20 pages. And I said, does this make sense to anyone that you're going to reconcile the cash account on December 31st to the November 30th bank statement? They said, well, no, it's well, no one uses it. They said, well, no one uses it. I said, well, I don't doubt no one uses it. It's the craziest thing I've ever seen. But yeah, it was really a weird thing that, that literally they had this rule that was impossible to do. So what do? They did the previous month, and by the way, the turnover at that position was really high. So I don't think anyone was going to make a big deal out of it because they weren't going to be doing it very long. But yeah, it was a really weird situation. But yeah, so instead of using the December one, they use the it could be December, whatever the year end is. Okay, and the last thing we're going to cover before we go on break is the cutoff bank statement. Some more room to get this on the same page. Okay, cutoff bank statement. Is made 7 to 14 days into the next month. Oops. The bank statement is sent directly to sent directly to the auditors. Actually, the one up here is also sent directly to the auditors. For example, okay, so, and by the way, this one up here, this is the year-end bank statement is also sent directly to the auditors. So the client will get it sent directly to them, and the auditors will also get it sent to them directly. Yeah, we didn't talk about that in this class, but the best evidence comes from third parties before the client gets a hold of it. So the bank statement, while the bank statement allows us to go to the client, at year end, the common practice, as it's followed by virtually everybody, is that the year-end bank statement also goes directly to the auditors. So the auditors will have the direct bank statement that the client has never touched. It's better evidence. The cutoff bank statement will go directly to the auditors. They might send it to the client. The client's probably not going to do anything with it, but the cutoff bank statement is done about 10 days into the following period. The reason why you do the cutoff bank statement is to see items that if the bank says, if the client says that these deposits were made on December 31st, just make sure that those deposits were made on December 31st. They should be in the bank statement by the 10th. Same thing with checks. The checks that were written in December, well, most likely they're going to hit the bank by January 10th. They may not all, but most of those should hit the bank. So it shows that, you know, the amounts that are paid out, that those amounts were actually sent out to whoever it is that they were supposed to be sent to. It can also find unrecorded liabilities, because anything that's paid out in that first 10 days of January is probably for something that was owed in December. Not always, but you know, you either look into it. But so if there are payments on there that were not on the books in December, you want to look into those. They may have taken the phone bill and stuck it in the drawer and never put it in the accounting system. You want to avoid that expense and make them look more profitable. Well, they got to pay the phone bill. So in January, they probably, write the check out or whatever and send it out. Well, that will hit the bank in the next 10 days. So you can actually find unrecorded liabilities that some of you have. So this cutoff bank statement is actually a very useful thing, because all those things that come to your, near the end of the period in cash, those will all be pretty much proven or disproven in the the cutoff bank statement. We'll stop there. So the two bank statements you get at the end of the year, one's the year end, and then one will be the cutoff, and the auditors will get both of those. Okay, let's stop there. And say be back at, well, here, you know what? I'm gonna pull up so the monetary unit sampling, this is also in the in the course documents. 705 maybe. Yeah, so the monetary unit sampling, this will be what we go over next, and that is in the course documents. It's also in the email. Okay. Okay, monetary unit sampling is, it's a sampling that is made specifically for auditing. And so it's unlike classical sampling, which could be used for a lot of different things. Monetary unit sampling is only used for auditing. It's specific to our field. It doesn't mean that it's always the best one to use, but in certain circumstances, it can be very useful. The advantages of it are that, excuse me, if the expected misstatements are low, it can really reduce the sample size, like sometimes, half as many. So you may be able to get, instead of taking a sample of 200 items, maybe you can take a sample of 90 items and be just as confident in those 90 items as you would with 200 of classical sampling. So it really reduces the amount of sampling in some situations. And sampling is one of the really time-consuming things about auditing. Going through, digging through the invoices, going through the shipping documents and all that kind of stuff can really take a long time. Even if you're doing it electronically, matching those things up can take a long time. But so reducing that, as you can imagine, is a big deal. It can't be used for everything, and we'll talk about what it's good for and what it's not good for. But the idea of it is that you will take chunks of whatever it is you're doing, they call it intervals. You'll take so you'll take a chunk of them, and then you take one item and have that one item represent the entire what they call interval, and I'll show you what I mean by that now. Okay, so here we have, what are these, accounts receivable, and we have 5,000 of the accounts receivable. And we're going to take a sample size of 5 items. So we're going to take 5 items and we're going to break this up into chunks. And I'll show you kind of, I'll give you kind of a, let me change cameras here. Yeah, basically what we're going to do is this. Oops. So we have accounts receivable, we have $5,000. We're going to break that up over 5 items. And so we're going to make these into this 5,000 into $1,000 chunks. And we're going to take one item, and that one item is going to represent that entire $1,000 chunk. These are called intervals. I'm calling them chunks. It probably shouldn't be, but so we're going to take one item from this one. We'll take one item from this one. One item. You're kind of seeing where this is going. So I take one item that'll represent that entire interval, that entire chunk of it. So we just split this $5,000 accounts receivable up into 5 $1,000 chunks. And our 5 items are going to each represent one of these chunks. Okay, so let's take a look at this again. So we're going to use this cumulative book value. And we're going to pick the items. So this cumulative, well, but first of all, let me explain this cumulative thing here. It just keeps adding them all up. So item 1 plus item 2 is 700. And as you go down the list here, you know, this will be item 1, 2, and 3 is the 13. So as it goes down here, so this just keeps adding them up until you get all the way down here, and you know, yeah, added up 4,100 plus the 900, it'll come out to that. So it just keeps adding on to it. Now, we are going to pick the thing that crosses this interval. So if you look at that cumulative total, whichever one crosses the $1,000 interval, that's the item we're going to pick. So which item crosses the $1,000 interval?
Number 3.
Yep. Let's make that green, I guess. Okay, so, find the interval. The interval is 1,000. And the first item we're going to pick is item number 3. Now we got to find the one that crosses $2,000. Which one crosses the $2,000 mark?
X.
Yep. So 6 crosses. Which one crosses the $3,000 mark?
7.
7. Yep. $4,000.
9.
Yep. And 5,000 is
10.
Yep.
Could you explain just the thousands one more time? Sorry, I was printing this off and I missed that part.
Yeah, we're looking for the item that crosses the $1,000 mark. So the first one, we're looking for the cumulative total. We're looking at which item crosses the first $1,000.
Mm.
And then we're going to look for the one that crosses the next 1,000, which would be 2,000 and 3,000 and 4,000 and 5,000. So we're looking for the item that puts us over this interval.
Gotcha.
Yep. And there's go ahead.
Oh, no, that seems easy enough.
Okay. Yeah, so whichever one crosses that total, you know, I'm going to pick. And I'll there's actually a genius to that, which I'll talk about later. Okay. So let me get rid of all these. Must be up. Oops. Oh, I shouldn't have done that. All right. So basically what we're going to be doing is it's sort of like that ratio estimation thing we did for classical sampling, where we did audit divided by book and then multiply it. We're going to do the same thing, except instead of multiplying it by the total 5,000, we're going to multiply it by the interval that one item represents. So it'll be the interval times whatever that ratio of audit over book is for the one item. So instead of doing it as the total of 5,000 like you do for the classical sampling, it's just gonna be for each interval. Okay, so first item was what, item 3? The audit amount was 600. And the book amount, so here's the audit amount. I'm going to change the colors on these. Let's see here. So the audit amount was 600. The book amount was 600. It's just one, right? I don't have the spacing here very well. Sorry about that. The interval was 1,000. So the projected value will be 1,000. And the projected misstatement will be 0. Because everything's okay, right? The 600 divided by 600 just 1. Bold that so we can see it a little better. Sorry about that. Yeah, so the notice that this is just the ratio, just like we did before for the ratio estimation. Okay. Show you how to be lazy. You cut and copy that. What do I do here? I'm sorry about the formatting on this thing. I was thinking when I did it. Okay, so the next item is item 6. And the book value for item 6 is 560. I said that wrong. The audit value is 560. The book value is 800. So 560 divided by 800 times 1,000, whatever that is.
Shouldn't it be 2,000? The interval?
The interval is always going to be the same. It's going to be the 1,000. Now, we did pick the one that went past the 2,000 interval, but the interval itself is sort of like this. The oops, not that. The interval itself will just be the 1,000. So we take one item from the 1,000. Yeah, we match them up. So this equals. So that's 700. And the misstatement will be 300. So we just did the ratio estimation on that. We said, okay, this interval is really only worth 700. So the misstatement of that interval is 300. All right, and let's go to 7. So 7, we have, let's not color all these. Now. Okay. So number 7. 450, 450. So if they're both, they're both the same, it's just gonna be the same. It's not gonna be any problem with it. Okay, number 9. 300. 750. So that's 400. This statement would be 600. Okay, so the totals here. Oops. And this thing is, I gotta redo this one. Okay, so the totals. The projected. Be 3,000 for 4,100. And the misstatement would be 900. So the total projected misstatement would be 4,100. No, misstatement. I'm sorry. Okay, a couple of things here. The first one is this automatically picks our sample. So we don't have to worry about picking a random sample that's not biased and all that kind of stuff, and making sure that somebody else can come in and pick that same sample and not be unbiased. We don't have to worry about that. This method, it says, okay, the one that crosses the interval, that's the one you pick. So it's already done for us. We don't have to try to figure out what, if it's a random sample. There's also something about the way that we pick these that makes this very good for auditing, and that is, I just say item. Okay, so if management is overstating accounts receivable or whatever it is, the more that they overstate it, the more likely it's going to cross that interval. And at a certain point, for instance, in our case here, if they had an account that they were overstating and it went over 1,000, it's guaranteed that item will be picked. So the more management overstates an account or a number of accounts, the more likely they are to be picked. It's increasing the chances of being picked if they are overstated. And again, if the overstatement, if the account is larger than the interval, it's 100% guaranteed that it's going to be picked, because it's going to cross an interval at some point. It might cross 2 intervals actually. Okay. Or more.
If it does cross 2 intervals, do you list it as both of the items?
Yes, we actually have a special thing that we do with that. But yeah, if it crosses 2 intervals, so it would count as 2 items being picked basically, and you just leave it at that. But if there is a misstatement, well, I'll wait for next week. We're gonna do that next week. But yeah, so if there is a misstatement, I'll show you what we do with that. It's a little bit different than what you'd think. This method is only good for overstatements. So that's what kind of the key is to it. But to answer your question, yes, you do count it. One item would count as 2. Oops. In this case, 1,000. Oops. Yeah, so if it's more than 1,000, it will definitely be picked. And again, that's really good for us. And even if management spreads it over a number of items, those items all have a larger, are all getting a larger percentage of possibility of being picked. So the more that they cook the books, the more likely they are to catch it. Which is, for auditing, if you think about it, well, that's great. The more they cook the books, the more likely you'll catch it. So anyway, so that's what this method is. Now, just to kind of you know, so far it sounds like, well, this is the perfect method for everything. It's not good for understatements. Notice if management reduces something, it lessens the likelihood that it will be picked. So something like accounts payable. You know, they want you to think they have less liabilities than they really have. So if they were to cook the books by reducing accounts payable, it's less likely you're going to find it. So things that are going to be, that the danger is them being understated, you would not use this method. What's it good for? It's good for things like revenues. It's good for things like assets. Things that are going to be likely understated, things like expenses and liabilities, use classical sampling. And by the way, when I was going through, this was kind of presented to us as, hey, this is the auditing, you know, sampling method, and this is the perfect one. It's way better than those lousy, you know, classical sampling and all that. But it really is only good for overstatements. To the point of, if there is an understatement, this method ignores it. And we'll talk about that next week. But you know, if it does find an understatement, it says everything's okay. Okay. Now, on this one, I gave you the sample size of 5, but there actually is a formula to use to get that sample size. And it's down here. It looks a little bit convoluted, but it actually is much easier than the classical sampling one. But anyway, this is the formula. And let's just jump right into it. Okay. Total book value. Tolerable misstatement. Expected misstatement. And 2 weird factor things. Liability factor and the expansion factor, which we'll get in a second. All right, so these are okay, so this top one, we're going to use a reliability factor at 0 misstatements. And if you go down the page, we have our reliability factors. And we're going to go for 0 misstatements. And the risk of incorrect acceptance is 5. And so that'll give us a factor of 3. So 3 is what we're going to plug in up here. And we're going to go to the expansion factor. Again, 5%. Expansion factor. Expansion factor is a little bit easier in that there's just one number or one row. So 1.6. Okay, so now we have to do some calculations. Okay, so 1,600,000 times. I'm gonna do this one first. So I should do that in my head. 4,800,000. Yeah. Let's try that again. So and on the bottom, I would probably do this part first, multiply this and then subtract it. So 5,000 times 1.6 and 120,000 minus whatever that is. The 8,000? Yeah. Okay, so 5,000 times 1.6 is 8,000. So 120 minus 8,000. 112. Okay, so 4,800,000 divided by 112 equals some number. There we go. 42.86. Excuse me. Okay, now we really can't take 40, we can't take 0.86 of an item, so we'll round that up to 43. Okay, so we're gonna take sample size will be 43 items. Now, the true method of this, for the two way to do it is to you round it off to the nearest whole item. I would tell you to always round up. Yeah, I remember that we're trying to, you're trying to get this, you're trying to get evidence that if you go into court, you can point at it and say, look, we did, we do what we're supposed to do. You don't want to have to go into court and say you round it down. I would say always round it up. It's going to be one more item, and it's, it'll end that conversation before it starts in court. So I would say always round up, but the true method is you round it off to the nearest one, the nearest whole item. In this case, it would be rounded up anyway. So, all right. All right, next thing I'm gonna do is find the interval. And we take the book value, total book value, and divide it by the sample size. Uh, All right, so 1.6 million divided by 43. $37,209. You probably don't need to put the cents in there, but if you did, it'd be like 30. Something like that. So it'll be 43,000, excuse me, 43 items and every 37,209. So the first one would be 37,209. The next one would be whatever, 74, 418.60 or whatever. Question on that? Okay, I'm gonna, we're gonna do one more. I just want to talk about this really quick though. The sample size and why this is initially, like what we just did, you think, okay, that looks way more complex than classical sampling. Classical sampling actually is much more involved to get the sample size. You have to get a basically like a standard deviation of the sample ahead of time, plug it into the formula, and then pick. So you have to do some work ahead of time to get the sample size, and then you have to randomly pick those items. You have to run a random number generator of some sort to get those items. Whereas this one, you know, once you get the sample size, which a little bit cumbersome here, but what took us like 5-10 minutes. It's done. It'll tell you what ones to pick, and you know, it's a very quick. It's actually a very quick method. Now there is something too about this method that makes it so much different than other methods, and that is this used to be called dollar value sampling. That was one of the names of it, and it was that every dollar has an equal chance of being picked. So every dollar in our cumulative, every dollar has the same chance of being picked. And you might say, well, so what? Well, when it comes to standard deviation, that's a big thing. Because, you know, if you have these are all just $1, you know, what's the standard deviation or the variance? Same, basically same thing. 0. Because they're all just ones. All right, let's go ahead and do the next one here. Now be careful on this one because this risk of incorrect acceptance is 10. So when you go down to these tables, make sure you use the 10 column. And again, on this one, you could either use 113, the real method is use 113, round it off. I would say use 114. Just because it, again, the whole purpose of it is to be able to point to it in court, and one more item is probably going to take, a couple minutes or something. Well worth it. Okay. So down here, so this will be the 22,500,000. I'm gonna use 114. I'll actually do it both ways. I'll do 114 and 113. That'll be pretty close. If you did 113, it would be and 113 really is the true method is 113. So if you use 114, it would be that. If you use 113, it would be. They're pretty close. I mean, not that big of a difference, but a little bit.
Who determines the risk of incorrect acceptance?
Sorry, that's an excellent question. This is judgment. Wait a minute. Either. I think I have an extra D. No, what do I have here? I did something wrong. Oh, I don't know. All right. Yeah, so this is why does that not look right? I guess it is right though. It's a judgment call. And yeah, I mean, you can, you say, okay, well, why don't you use 1% or 5% or 10%, And here's the thing, a lot of times you kind of get the feeling like that if you do it statistically, that you are covering your bases and all that. But the truth of the matter is, if you pick 1%, 5%, or 10%, that's a judgment call. How sure do you want to be, or how sure do you need to be to sign off on the audit report? But yeah, it's judgment, which is why auditing is so difficult, because it's judgment. It's hard to teach that. It's hard to learn it, most auditors learn from other auditors. When if you go into auditing, your first jobs and all that kind of stuff, you're going to kind of learn from the other people who are around you. And when I went through it, I had some people who were great. There's a couple of them that weren't so great, but I had some people who were great at teaching, how to kind of think about it and how to go through it. And yeah, you kind of learn that judgment quality. Again, I've had some bad ones. I had a guy that actually wrote up an audit report for, I think it was $2.38. That there was a misstatement of $2.38. It cost way more to write up the audit, the audit point for that than it did. But anyway, I had some really good people though that I don't know if it's kind of mentoring or supervising or whatever you want to call it, but yeah, it's a learned thing. And there are no, the ACCT433 does not come out with any guidelines on, do you audit to what percent level? Do you audit it to 1%, 5%, 10%, 20%? There are no guidelines by the ACCT433 or PCAOB on that. Question on this? Now, again, while this is a little bit cumbersome, it's going to take a few minutes to go through it, but when you're done with it, you have the number of items in your sample that you're going to need, 114 or 113, and you have your interval. You basically have the sample picked. So there are some real advantages to it, even though it doesn't seem that way now. There are some real advantages though to doing it this way that are make this method not only a lot of times pick a smaller sample, but also much quicker to choose that sample. Okay, let's stop here. I don't think there's anything to turn in this week. Well, wait, there's still the, I think the test is due tomorrow. And I don't know if some of you have already turned it in. By the way, when I first went through the grading, I didn't have the extra credits added in, but I did do now for those that are graded. But yeah, so there's nothing to turn in this week because we're not done with the chapter 10 handout. We're not done with this one. So just turn that in. If you already turned it in, well, take the week off. I don't know, do something fun. Okay, any questions? All right, well, I've had enough of this. I hope you guys have. And I will see you guys in a week's time. All right, have a good night.
Thank you. Have a good night.
Oh, did someone want to see the chapter, the first part of